Hello friends, hope you're doing well. This is Chris Lee, CPA, back with another video for you, talking about year-end 2025 tax reduction strategies. And today we're going to talk about the Section 199A qualified business income deductions. So now, if you own a pass-through entity, or maybe have a side hustle where you're self-employed, as a sole proprietor, or through what we refer to as a disregarded entity, LLC, you may have come across the idea of what is called a qualified business income deduction or Section 199A deduction. And really what this is, this was born out of the 2017 Tax Cuts and Jobs Act, where it gave a free 20% tax deduction based off of your business income to individual taxpayers. And so it's just a nice, like, here you go for being entrepreneurial. Here's a 20% deduction on that business income. Now, what is important to know is that the One Big Beautiful Bill made this deduction permanent. Previously, it was set to expire at the end of 2025, and now it is made permanent. Now, as your income starts to grow and you start making more money, the 199A deduction becomes more complicated because, as we all know, in tax laws, like, there's always going to be some amount of complexity thrown in there as your income grows, and they always have threshold amounts and whatnot that you have to manage and cutoffs. So when it comes to 199A, the qualified business income deduction, we first need to understand that if you're single and your income is below $197,300 for 2025, or if you're married filing jointly, $394,600, what you'll find is your qualified business income deduction is just that standard 20%, generally, assuming that your taxable income is, higher than that from wages or interest and dividends or what have you. You can use 20% of your qualified business income as a deduction. Now, once you're at those threshold amounts, your deduction may start to be phased out. And so what happens is, if you're single, you've kind of got this $50,000 gap where that deduction is phased out. And so from that $197,300 to $247,300, that 20% deduction starts to phase down. And then for a married filing jointly couple, $394,600 to $494,600. So it's a $100,000 threshold gap that we're working with. Once you're at that $494,600, it becomes a little bit more complicated, and the mechanisms of the deduction are different than just like a straight 20% haircut. And so that's the things you've got to worry about. Now, when it comes to Section 199A, it's always important to remember that whenever you do something to reduce your taxable income, your 199A deduction also is going to go away, because the deduction is limited not just to 20% of your qualified business income, but it's also limited by your taxable income. So 20% of your taxable income, if that's going to be lesser than the deduction of 20% of your qualified business income, it's going to be 20% of your taxable income. So an example of this is, say you've got $100,000 of qualified business income and taxable income of $100,000, you're going to get a 20% deduction. But let's say that $100,000 you take, you buy equipment, take accelerated depreciation, and you now have, and say it was $40,000, you now have qualified business income, not $100,000, but $60,000. So 100 minus 40. So now your qualified business income is $60,000, and then you take 20% of that, which means your deduction is $12,000. So that's just an example to say that any tax planning you do that reduces your business income also reduces your 199A. Now, when you start getting in those threshold ranges where the deduction starts to phase out, that isn't necessarily the case. At that point, we want to reduce our income so that we make sure that we aren't getting phased out of our deduction, right? So just because we reduce our taxable income doesn't mean our deduction goes down proportionally, right? Because it's basically slowly turning on and off the switch that is that deduction when you're in those threshold ranges. And then once you're at the top end of those threshold ranges, the calculation just becomes rather different. And that is a function of depending on what type of business you have. So if you're in what's called a specified service trader business, say accounting, like what I do, or law, or medicine, or consulting, performing arts, something like that, anything where it's kind of your reputation is the reason that you that you make a living, it's going to be deemed a specified service trader business. And at those threshold amounts, the deduction is just completely turned off. It goes to zero. Once you're at the 247,300 for single filers, or the 494,600 for married filing joint filers. Now, if you're in a non-specified service trader business, then the calculation becomes much more a mechanism of W-2, wages that are paid out through the qualified business, and then also the assets that are employed underneath. So the basis of those assets, the unadjusted basis of those assets. But this isn't so much an exercise in understanding all the mechanisms that go into it, because the calculations are complicated. And then if you've got multiple businesses, how they all interact can get interesting. The most important thing to know, though, is that when your income starts to exceed those threshold amounts, we really want to start implementing the strategies that get our income down so that we can bring our deduction up. So that's the funny thing of it, is when we're in those threshold amounts and the deduction starts phasing out, as we bring our income down, we're also going to be bringing our our qualified business income deduction up, which means we're getting, the mechanism of two directions, of more deductions on the business and more deductions from the qualified business income deduction, which is all bringing our taxable income down. So the first strategy to understand or to think about implementing is harvesting capital losses that reduce your taxable income. So capital gains add to your taxable income, which is going to determine your eligibility of the 199A deduction. And then it's also important to know that your taxable income less your capital gains is what sets the upper limit or ceiling on the amount of your Section 199A deduction. So if the capital gains are hurting your Section 199A deduction because of the threshold amounts, you can go ahead and actually harvest capital losses to get that income down. One thing so harvesting capital losses is to say, hey, I've got some capital assets, whether that's stock or crypto or something similar, and I'm going to go ahead and sell off those assets that have a built-in loss. So maybe what I bought it for was $100, and it's right now worth $60. So I have a built-in loss, or its fair market value is less than what I paid for it. I'm going to realize that loss. Doing that in large enough amounts of magnitude, you'll actually start bringing your taxable income down, which brings back the capacity for your 199A deduction, which is great. And the more deduction of the 199A, the more we're going to bring our taxable income down as well. So when it comes to harvesting capital losses, a couple things to remember is that if you're harvesting losses in a stock portfolio, always remember the wash sale rule. So that's to say, if you sell a stock and you otherwise would have, so if you go to sell a stock and you rebuy that stock within 30 days after selling it, that loss that you triggered is disallowed. And so you just want to make sure that that is not the case if you are holding direct crypto assets, maybe in Coinbase or something like that. That doesn't apply. So that's the nice thing in harvesting losses, maybe if you have a crypto portfolio. But either one will do the trick. So harvesting capital losses to offset maybe some larger capital gains that you have that'll be flowing to your tax return. Really just remember the wash sale rules. That's the most important thing if you're going to be using harvesting losses in a self-managed account. If you do work with an investment advisor, it's worth maybe having the conversation saying, hey, what can I do to get, not just like harvest capital losses to offset the capital gains in the portfolio that you're managing for me, but I need much more capital losses to the extent possible to be able to offset some other non-brokerage or maybe some non-managed capital gains that are coming through, so that I can get my taxable income down, manage my 199A consequences, and get the maximum benefit for the year. The second strategy would be, if you're going to be itemizing your deductions, go ahead and maximize your charitable contributions. So this was mentioned in another video, but one way to do this is to donate appreciated stock. So this is to say, if you bought stock maybe for $1,000 and now it's worth $50,000, if you can go ahead and donate that stock directly to the charity of your choice, without recognizing a capital gain, and take a $50,000 tax deduction for it, and as a charitable contribution deduction. So that is a big way to get more deductions without triggering more gains. So that's one way to do it, is donating appreciating stock. The second piece would be maybe prepaying some of your planned charitable contributions for the next tax year. One way I recommend this is to do a donor advised fund. So maybe you're not decided on what organizations you're going to give to in the following year. So you can go ahead and put that into an account called a donor advised fund. You can get those at Fidelity, fairly easy and straightforward to do. You can put the dollars in before 12/31, 2025, get the deduction in for your 2025 tax year, and then actually distribute those funds in 2026 to be able to qualifying organizations. So it's functionally prepaying without having to make the decision of what organizations you'll be giving to. The third strategy you might consider is looking at accelerated depreciation and buying some assets that maybe you were deferring to the following year. Go ahead and move those asset purchases up, and we'll consider taking some accelerated depreciation. We can do this under bonus depreciation rules under 168K, or we can do this under the expensing rules of Section 179. So either way, we can reduce taxable income to increase the Section 199A deduction by writing off, material assets that you're gonna have purchased. So it can contribute to your Section 199A deduction if your deduction currently uses the calculation that does look at the wages and the unadjusted basis of the assets. So once you get to the higher ends of those thresholds and you're not a specified service trader business, you can have your calculation isn't just like straight 20%. So that's the good thing about buying those assets. If you are at the threshold amounts, and you can't even get below the threshold amounts, what you're going to end up doing is still creating more capacity for your Section 199A deduction because of the basis of those assets. So that's the big benefit there. And then the last few strategies are kind of all the same, but if you're not otherwise doing it, I'd recommend maximizing tax-advantaged retirement accounts. That's going to reduce your taxable income. If you're kind of in that threshold range, I'd also consider HSA contributions. Those are also other good strategies. So that's kind of the fourth bucket. Maximize your tax-advantaged retirement accounts that are on a pre-tax basis. So that means that you get the deduction on the front end. So those are just a few quick strategies. If you're kind of at that $197,000 or $394,000 threshold for your taxable income, and you're kind of getting over those thresholds and your QBI deduction is starting to go away, we want to think about, harvesting some losses to offset capital gains if we need to. We don't want too many capital losses because excess ones are only allowed at $3,000. We just need enough to get that net capital gain down. To make charitable contributions, that could be prepaying 2026 into a donor advised fund or donating appreciated stock. Number 3 would be buy and place in service business assets that can be fully expensed. So think non-listed assets and not vehicles. So a lot of vehicles can have some restrictions on them, but think heavy machinery, office furniture, computers, those sorts of things. And then 4 is taking advantage of your tax-advantaged retirement accounts. So HSA, pre-tax IRA if it's available. If you can manage it, well, if you're at those threshold amounts, you might not be at the available to you to be able to take the deduction. But then but also consider, 401k plans, solo 401k plans, those sorts of things, SEP accounts, SEP IRAs, those sorts of things. So as you're working through your year-end tax planning, go ahead and think through those items. If you're worried about your Section 199A deduction, if you want kind of more tailored and specific advice as to like what you might be facing, you can go ahead and connect via the link in the recording description, and from there we can have a specific consult. So I look forward to working with you if it seems appropriate, and we'll go ahead and have another video for you soon. Take care, friends. Bye-bye.